Welcome to the Ultimate Beginner's Guide to Volume Trading. In this free video course, you are going to learn the basics of using volume as a way to confirm price movements or to anticipate market reversals. You are going to learn about volume spikes and volume drops, the standard rules for interpreting volume patterns in all time frames, the relationship between price, volume, and open interest in the futures market, and the relationship between volume and volatility. We're also going to study the most common volume indicators like the volume histogram, volume oscillator, unbalanced volume, the money flow index, the Herrick Payoff Index, accumulation distribution, and the volume profile. Before we begin, please remind that this video is made for educational purposes only. This is not investment advice of any kind. If you decide to use the techniques presented in here, do it at your own risk. We begin first by the definition of volume. Volume is a measure of how much a market has traded in a given period. In other words, it's a measure of market activity. This measure changes a little bit depending on the market we are talking about. For example, if we are talking about stocks, volume is measured by the number of traded shares in a given period. If we talk about futures, volume is measured by the number of traded contracts in a given period. And if we talk about currencies, volume is measured by the number of ticks in a given period. A tick is simply the minimum price change, so tick volume is nothing more than the number of times that a currency has produced the minimum possible price change within a given period. Whether we are talking about real transaction volume, the number of traded shares, the number of traded contracts, or the tick volume, we are talking about measures of market activity in one way or another. For example, if the total transaction volume is higher, the total number of traded shares or contracts will probably be higher, and the tick volume will probably be higher too. In summary, these are slightly different ways of measuring the same thing. Given the definition of volume and the fact that slightly different measures of volume reflect market activity in a similar way, let's begin talking about the simplest patterns we can find in volume. We begin by talking about volume spikes and volume drops, since they are the two fundamental volume patterns. A volume spike is a significant increase in volume. To be classified as a volume spike, the volume in a particular period must be a few times larger than the average volume. It's usually something that stands out immediately when we look at the volume histogram. A volume spike means that something significant has happened, and many traders or investors have entered the market with a unique bias. There are basically two types of volume spikes. There's the sudden spike and the crescendo spike. The sudden volume spike is the one that happens abruptly, and it's usually the result from major unexpected news or major releases that are expected, like economic indicator releases or balance sheets. When we talk about events that are scheduled, the volume spike appears abruptly in the chart, but it is expected. When we talk about unexpected news, the volume spike is sudden and unexpected. As we can see in the chart, this volume pattern produces a sudden spike. The sudden spike will confirm the price movement at the corresponding period. Notice how the volume increases sharply above the average volume highlighted by the black line in the volume histogram. There is also the crescendo spike, which, as the name suggests, is a spike that is preceded by a crescendo or gradual rise in volume. This happens as a result of buyers and sellers increasing activity in the market for whatever reason, which might not necessarily have to do with news events or economic releases. In this chart, we can see a crescendo spike, meaning a slow rise in volume that eventually peaks and then drops. In summary, the sudden spike represents an abrupt increase in market activity, while the crescendo spike represents gradual increase in market activity. A volume drop is a less dramatic event, but it also contains important information about the market. A volume drop is represented by a decrease in volume or a decrease in trade activity. A drop in volume means that supply and demand are near an equilibrium state, so oftentimes you will see price moving sideways as volume drops. If you don't know how supply and demand works, watch the Ultimate Beginner's Guide to Supply and Demand Trading in the YouTube card. In this chart, you can see how price oscillates within the blue rectangle while volume gradually drops. Notice also how I'm giving examples of different markets to show how slightly different measures of volume relate to the same thing. The examples showed a sudden spike in currencies, crescendo spikes in stocks, and a volume drop in futures. Volume spikes and volume drops are the two most basic patterns that emerge in volume histograms. Given these two basic patterns, we can move on to the standard interpretation of volume in relation to price action. The standard interpretation is made by comparing patterns in the volume histogram to price action. We have 4 basic interpretations. When volume is rising and price action is also rising, we have the confirmation of a bullish movement. In other words, the bullish movement has enough volume to be sustained. When volume is rising and price action is falling, we have the confirmation of a bearish movement. In other words, there is enough volume to sustain the bearish movement. When volume is falling and price action is rising, we have a weak bullish market, meaning that volume is not sustaining the current market movement upwards. When volume is falling and price action is falling, we have a weak bearish market, meaning that volume is not sustaining the current market movement downwards. In this chart of the Dow Jones Index, we can see one of the many situations that happen between price and volume. In the first leg of this downtrend, we have a sharp rise in volume that confirms the bearish market. In the second leg of the trend, we can see volume declining, and that's an indication that the bearish market is getting weaker. The uptrend begins after the downtrend stops having enough volume to sustain it. Beyond this standard interpretation of volume, an increase in volume can be used as a breakout confirmation or as a proxy for the overall market bias. In this chart, we can see a clear increase in the volume histogram as price breaks below the price channel, therefore confirming the breakout. In this other chart, we can see how volume might be used for the detection of the overall market bias. When volume in the upward movements is higher than the volume in the downward movements, we have a bullish bias. When volume in the downward movements is higher than the volume in the upward movements, we have a bearish bias. In this chart, we can see an example of a bearish move and a bullish move where the bearish leg produces a higher volume than the bullish leg. We can view this as an overall bearish bias. Here we have to be careful because upward price movements have lower volatility and higher time duration, while downward price movements tend to have higher volatility and lower time duration. When attempting to use volume to measure market bias, it's interesting that the trader uses price movements of similar time duration because of this asymmetry between volatility and time in upward and downward price movements. As a general guideline, volume confirms price action. That's interesting because comparing price and the volume histogram is a way of analyzing the market that is devoid of lag, so volume can indeed be a leading indicator in that sense. Beyond volume, there is the concept of open interest, which is something that can only be used in the futures market. Interest is when new buyers or sellers enter in a market. That implies that we have old buyers and sellers and new buyers and sellers. When these two different groups of new and old buyers and sellers meet, they alter the dynamics of the market in specific ways. When new buyers meet new sellers, we have an increase in open interest. When new buyers meet old sellers or new sellers meet old buyers, we have no change in open interest. When old buyers meet old sellers, we have a decrease in open interest. The combination of volume and open interest gives rise to new possibilities of interpretation for the particular phases of a trend. It's generally accepted that when volume is rising and open interest is rising, the trend is confirmed. When volume is rising and open interest is falling, we have the phase of position liquidation. When volume is falling and open interest is rising, we have a period of slow accumulation, which happens before an uptrend. When both volume and open interest are falling, we have a congestion phase, meaning a sideways market. We'll see an example of this when we look at the Herrick Payoff Index, which is a volume/open interest indicator made to be used in the futures market. We could go a step further and add that price movement to the standard interpretation to generate even more interpretations. When price, volume, and open interest are rising, it means that new buyers are entering the market. When price, volume, and open interest are falling, it means that the downtrend will end. When price is rising and both volume and open interest are falling, it means that money is leaving the market. When price is falling and both volume and open interest are rising, it means that bearish money is entering the market. We can also find an interesting relationship between volume and volatility. As a rule of thumb, we can state that high volume goes with high volatility. There are exceptions to this, of course. Not all periods that have high volume will necessarily produce high volatility. In this chart, we can clearly see the relationship between high volume and high volatility. Notice how, as volume begins to rise, the standard deviation indicator, which is one way of measuring volatility, also starts to rise. We must now move on to the most famous types of volume indicators. These indicators aim to give further insight about the relationship between volume and price in a way that raw volume is not able to accomplish. Whether or not these indicators achieve this goal is a different story. As many of you know, I'm not a fan of most technical indicators for a variety of reasons, but the goal of the Ultimate Beginner's Guide series is to show what the industry uses while highlighting the advantages and exposing the disadvantages of any particular technique. With that said, let's move on to the study of the most famous volume indicators. I'm going to focus only on the most relevant, but you will find dozens of volume indicators if you do some research. The first indicator we're going to study is the simple volume histogram, which is the indicator that we have been using so far in the video. The volume histogram is the simplest and most intuitive volume indicator, and probably the most reliable also. The height of the bars indicates the amount of volume in that particular period, and the color of the bar in the case of TradingView indicates if the corresponding candle is bullish or bearish. If the corresponding candle was bullish, the bar in the volume histogram will be green, and if the corresponding candle was bearish, the bar in the volume histogram will be red. This is the indicator we use to detect volume spikes, volume drops, and the relationship between volume and price action. I said this is the simplest and probably the most reliable volume indicator because there is no lag built into it, no formulas, and no unrealistic assumptions. Traders usually plot the average volume on top of the volume histogram to create a reference point for deciding if volume is high or low. The average volume is nothing more than the average of the last n periods in the volume histogram. Just like a moving average smooths out the last periods in price, the average volume smooths out the last periods in volume. The most used period for the average volume is 50. Since this is an average, it will produce lag, so you need to keep that in mind. The histogram itself is devoid of lag, but the moving average of volume contains lag since it is a smoothing filter. One disadvantage of the volume histogram is that it can be difficult to read since it's the raw volume. This problem can be minimized by using the next indicator we're going to study, which is called volume oscillator. The raw volume histogram can sometimes be erratic and too chaotic to analyze. The volume oscillator makes it easier to observe the rise and fall in volume by calculating the difference between a fast and a slow moving average of the raw volume. The formula for the volume oscillator goes as follows. In this formula, the fast moving average has a period f, and the slow moving average has a period s. The term V sub I in the formula is the volume at index I. For example, the current period has an index of 0, the previous period an index of 1, and so on. The sigma means the summation notation. It means the formula will sum everything starting from the bottom until the top. In other words, the summation will begin at I equals T minus F plus 1. F is the fast moving average period. The plus 1 needs to be introduced in the formula because the current period starts at the index of 0, not 1. So the last 14 periods, for example, go from index 0 to 13 instead of 1 to 14. Once we get the summation, we divide by the number of periods as we do in a simple moving average. The same process is repeated for the slow moving average. The final volume oscillator value comes from the difference between the two averages. There is an alternative calculation method for the volume oscillator, which instead of the difference between the moving averages, it uses the ratio between them. The standard calculation uses the difference. In this chart, we can see how the volume oscillator captures the overall movement of the volume histogram with minimum lag. The highs and lows in the volume oscillator align with the highs and lows in the volume histogram, but the movement is a lot easier to observe in the volume oscillator. Next in line, we have an indicator called on-balance volume, or OBV for short. This indicator was made famous by Joseph Granville, and it is a way to accumulate the raw volume information without using some sort of average. The unbalanced volume indicator assumes that on bullish periods, meaning candles that are bullish, the volume is entirely represented by buyers, and on bearish candles, the volume is entirely represented by sellers. The indicator accumulates volume positively in bullish candles and accumulates volume negatively in bearish candles. In this chart, we can see an example of bearish volume being subtracted from the unbalanced volume indicator. The OBV value in the first period is minus 1.884 million, which means minus 1.884 times 1 million. In the next period, we have a large bearish candle with a volume equal to 35.187 thousand, which is the same as 35.187 times 1000. This value will be subtracted from the OBV value since it's a bearish volume. The resulting OBV value will be minus 1,884,000 minus 35,187, which equals to the next OBV value of minus 1,919,000. Even though volume increases in the second period, the OBV value went down because bearish volume is subtracted from the indicator value. In this chart, we have an example of a bullish candle adding to the OBV value. The volume corresponding to bullish candles count as positive volume on the OBV. The large bullish candle has a volume of 62,803. If we add that to the previous OBV value of minus 2,105,000, we get the value of minus 2,042,000. We can summarize the OBV value using the following formula. If the current closing price is higher than the last closing price, then the OBV equals to the OBV value in the last period plus the volume of the current period. If the current closing price is lower than the last closing price, then the OBV equals to the OBV value in the last period minus the volume of the current period. Another way of seeing the calculation for the OBV indicator is that the current OBV value, also called OBV sub t, is equal to OBV sub t minus 1, which is the OBV value in the previous period, plus the closing value at time t minus the closing value at the previous period, divided by the absolute value of the closing value at t minus the closing value at t minus 1. This fraction will always result in either plus 1, 0, or minus 1. That serves to either add volume or subtract volume from the previous OBV value, depending on whether we are talking about bullish or bearish periods. The OBV has a standard interpretation that goes as follows. When price is going up and the OBV is also going up, we have a strong uptrend. When price is going up and the OBV is going sideways, we have a moderate uptrend. And when price is going up and the OBV is going down, we have a weak uptrend that might be near a reversal according to the standard interpretation of volume. When price is going sideways and the OBV is going up, we have what's called an accumulation, which is a sideways market that happens at a bottom. When price is going sideways and the OBV is also going sideways, there is no clear determination of the market scenario. When price is going sideways and the OBV is going down, we have what's called a distribution, which is a sideways market that happens at a top. When price is going down and the OBV is going up, we have a weak downtrend. When price is going down and the OBV is going sideways, we have a moderate downtrend. And when price is going down and the OBV is also going down, we have a strong downtrend. The OBV has a dangerous assumption, which is to consider that in a bullish bar, all the volume comes from buyers, and in a bearish bar, all the volume comes from sellers, which is clearly not true. However, on the bright side, the OBV is an indicator devoid of lag, which is what you should look for when trying to use technical indicators. The OBV is also not limited to a fixed window, and that avoids some unwanted distortions. In this chart, we can see one of the examples of using the standard interpretation of the OBV indicator. In both price movements highlighted, we have price going up and the OBV indicator going sideways, which indicate a moderate uptrend. Notice how the upward price movements are not too dramatic, they precede more violent bearish movements. In the downward movements after these two upward movements highlighted in the chart, we can see that price action and the OBV were going in the same direction, therefore signaling a strong downtrend. The next indicator we're going to study is called Money Flow Index, and it is similar to the OBV and the RSI in a few different ways. It uses the typical price instead of closing prices, and the indicator is constrained within a fixed range that goes from 0 to 100, which makes it an oscillator. The Money Flow Index is like the RSI, but with the element of volume added in. Let's take a look at the formula first to understand a few details about the Money Flow Index. This indicator is based on the typical price instead of the closing price. The current typical price, denoted as TP sub T in the formula, is nothing more than the sum of the high, low, and close divided by 3. To calculate the Money Flow Index, which is denoted as MFI in the formula, we need two other values first: the positive money flow, denoted as MFP, and the negative money flow, denoted as MFN. The Money Flow Index is calculated using a period like a moving average, unlike the OBV, for example, which is a cumulative indicator. If the current typical price is greater than the previous typical price, then the positive money flow is equal to the positive money flow in the previous period plus the current typical price times the current volume. If the current typical price is smaller than the previous typical price, then the negative money flow is equal to the negative money flow in the previous period plus the current typical price times the current volume. The positive money flow is the sum of all the periods where the typical price at t is greater than the typical price at t minus 1 within the predetermined indicator period. The negative money flow is the sum of all the periods where the typical price at t is smaller than the typical price at t minus 1 within the predetermined indicator period. Dividing the positive money flow by the negative money flow, we have the money flow ratio, which goes directly into the money flow index formula. The money flow index indicator is quite similar to the RSI, but it incorporates the volume element into it. When we talk about oscillators, the most reliable technique is divergence. In fact, divergence is one of the very few things in technical analysis that is worth studying. Since the money flow index is very similar to the RSI, but incorporates the volume element into it, sometimes the money flow index indicator will show divergences that the RSI doesn't show, that can create interesting opportunities. In this chart, we can see an example of the money flow index indicator showing a bearish reversal divergence when the RSI was showing no divergence at all. You can use these different types of divergences to confirm each other, for example. Just as a parenthesis, you will always hear about things like overbought and oversold levels in oscillators, but that's completely useless since price charts are a non-stationary type of time series. If you want to learn more about that, watch a video I posted called The Dark Secrets of Technical Analysis in the YouTube card. The next indicator we're going to talk about is called Herrick Payoff Index. This is a less known indicator that combines volume with open interest, but it can only be used in the futures market due to the necessity of open interest data. The formula for the Herrick Payoff Index is a little more complex, and it goes as follows. The Herrick Payoff Index is equal to the conversion factor, which is the value of a one big point move times the volume for today, times the difference in the mean values where m equals high plus low divided by 2. All of that times 1 plus the difference in the mean values divided by the absolute value of the difference in the mean values times 2 times the absolute value of the change in open interest divided by the smaller value for the open interest for today or the previous day. This is an indicator that can be used in combination with another volume indicator to detect the various kinds of interpretations we saw previously in the table that relates price with volume and open interest. To compare price, volume, and open interest, the trader can use a combination of the Herrick Payoff Index and the volume oscillator to see volume fluctuations more clearly in raw price. Remember once again that the Herrick Payoff Index can only be applied in futures and in the time frame that corresponds to the open interest data. In this chart, we can see a very clear example of the Herrick Payoff Index being used in the daily S&P futures. In the highlighted price movement, the Herrick Payoff Index is going down while the volume oscillator is going up. According to the interpretation of volume in alignment with open interest, this means a liquidation. In other words, a violent bearish movement, which is exactly what happened in this chart. Another notorious volume indicator is called accumulation distribution. It detects buying and selling pressure by measuring the ratio between the size of the candle body and the size of the candle range, multiplying that by the volume and adding to the previous value of the indicator. So it's a cumulative indicator like the unbalanced volume. The accumulation distribution indicator has a very simple interpretation. When the indicator line is moving in the same direction of price, it's basically confirming the price direction. If the indicator line and price section diverge in direction, it means the possibility of a reversal. In this chart, we can see the accumulation distribution indicator plotted on top of price. On the left, we can see that both price and the indicator are moving up, so there is a confirmation about the price movement. On the right, we can see that price is going up and the indicator is going down, therefore signaling a distribution, which means the imminence of a bearish move. After the signal, the market indeed turned to the downside. Perhaps a more reliable way of using the accumulation distribution indicator is to compare highs and lows in price with highs and lows in the indicator like we do in other oscillators such as the RSI and the money flow index. The divergence signal works exactly in the same way as it does in the RSI and the money flow index. In this chart, we can see that the accumulation distribution indicator showed bullish reversal divergence signals that the RSI was not able to detect. It's a similar situation to the comparison between the RSI and the money flow index. Sometimes the volume-based oscillators or accumulators will display divergences that the momentum oscillators are not able to capture. One major flaw of the accumulation distribution indicator is that its formula doesn't compare the price range between periods. So when gaps occur, for example, the indicator and price action will become out of sync and will produce unreliable signals. Another interesting volume indicator is the volume profile. This is a more advanced indicator with many different settings, but the best results can be achieved by using the simplest features. The volume profile displays a horizontal histogram that shows the various volume values of different price levels within a specific range determined by the user. In basic terms, the volume profile will show areas where the price has traded the most within the range determined by the user, and these areas tend to be used as support or resistance. In the volume profile indicator, we have a red line called POC, which stands for point of control. The point of control is the price level with the highest traded volume within the range specified by the user. The basic interpretation of volume profile is that a high volume price level represents an area of consolidation or barriers for price. Low volume price levels represent trending areas or free space for price to travel. That makes sense because when there is a consolidation, price tends to stay around the same area for a long period of time, and therefore the total volume in such price level will be higher. When price is trending, it doesn't stay around the same level. It travels to the upside or to the downside, leaving a low volume trail along the way. In this chart, we have an example of this technique being applied in the mini S&P. The volume profile was placed in the price movement highlighted by the blue line. The histogram on the left showed the various price levels and their respective volumes. The red line is the point of control, meaning the price level with the highest volume or the highest value in the volume profile within the blue price movement. The black horizontal line is simply an extension of the red point of control. Notice how the point of control can be later used as support. Let's now talk about some different conclusions we can reach when dealing with volume in its many different representations. Most volume indicators are either raw, cumulative, or oscillators, meaning they will have little to no lag. In general terms, that's a good thing because lag is something traders should always try to avoid. Some of the indicators make bold assumptions. For example, the OBV assumes that all volume in a bullish candle comes from buyers and all volume in a bearish candle comes from sellers, which is clearly not true. The standard interpretation of volume is something interesting to keep in mind when analyzing the different phases of a trend. The volume profile can be an interesting alternative to find hidden support and resistance levels that have the volume element as an extra layer of confirmation. Volume doesn't work by itself. It must be analyzed in context with other techniques to produce more reliable results. This finishes the ultimate beginner's guide to volume trading. If you enjoyed the video, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. If you want to learn more about trading, please visit my website fractalflowpro.com. Thank you very much for watching, and I hope to see you in the next videos. Take care.